Investing is not a game of high intelligence, according to Charles Munger. It's a game of good judgment, according to him. Good judgment comes from having the right mental models in your head, Munger taught. You can be the smartest person in the room and still make terrible investment decisions if you're thinking with the wrong framework, according to Munger. Munger has watched very bright people lose everything because they relied on emotion, on stories, or on the latest market excitement instead of using rational models that actually explain how the world works, according to him. You can't make sense of the market without mental models, according to Munger, any more than a pilot can fly without instruments, according to Munger. The market is noisy, confusing, unpredictable, and often downright irrational, according to Munger. If you try to navigate it with intuition alone, you're going to get lost, according to Munger. You're going to pay a heavy tuition for your mistakes, according to Munger. When Munger talks about mental models, he's talking about the key ideas from different disciplines that help you see reality clearly, according to him. Human nature hasn't changed in thousands of years, according to Munger. The market is nothing more than human nature on display, according to Munger. People get greedy, fearful, impatient, overconfident, and confused, according to Munger. If you don't recognize these forces, you'll become a victim of them, according to Munger. A solid mental model can save you from your own impulses, according to Munger. Instead of reacting emotionally to price swings or headlines, you can stop, think, and ask yourself which model applies here, according to Munger. Most people look at investments the way a child looks at candy, according to Munger. They want what's exciting, colorful, and popular, according to Munger. But that's not investing, according to Munger. That's speculation, according to Munger. Real investing requires understanding the underlying forces that make businesses succeed or fail, according to Munger. It requires understanding incentives, competitive dynamics, human bias, and the mathematics of compounding, according to Munger. Without mental models, you end up chasing whatever looks good on the surface, according to Munger. With mental models, you start asking deeper questions, according to Munger. What is the real value here, according to Munger? What assumptions am I making, according to Munger? What can go wrong, according to Munger? What does the long-term picture look like, according to Munger? The truth is that you don't need hundreds of models, according to Munger. You just need a few dozen very good ones taken from psychology, economics, history, and science, according to Munger. And you need to use them consistently, according to Munger. The market punishes inconsistency, according to Munger. It punishes emotional overreaction, according to Munger. It punishes people who think in straight lines and ignore second-order effects, according to Munger. But it rewards those who approach it with clarity and discipline, according to Munger. When you see the world through strong mental models, you stop being surprised by market behavior, according to Munger. You understand why bubbles form, why crashes happen, why businesses decay, and why patience is rewarded, according to Munger. Mental models keep you humble, according to Munger. They remind you of your limits, according to Munger. They keep you from making big, destructive mistakes, according to Munger. Almost every disaster Munger has seen in investing could have been avoided by applying the right model at the right time, according to him. That's why Munger says the models in your head will matter far more than the numbers on your screen, according to him. Anyone can look at a chart, according to Munger. Anyone can read a balance sheet, according to Munger. But very few people can interpret what they're seeing with clarity and honesty, according to Munger. Before you try to outsmart the market, start by upgrading the way you think, according to Munger. Build a better system in your mind, according to Munger. Investing becomes far less confusing when you stop relying on emotion and start relying on mental models that reflect how the world actually works, according to Munger. That's how you become a better investor, according to Munger. Not by being brilliant, but by thinking better than most people ever will, according to Munger. One of the greatest advantages any investor can have is knowing exactly what they understand and what they don't, according to Munger. That simple idea is what Munger calls the circle of competence, according to him. It sounds modest, almost obvious, but most people never follow it, according to Munger. Human beings have a natural tendency to overestimate their knowledge, according to Munger. They want to believe they can judge anything, buy anything, analyze anything, according to Munger. That habit leads them straight into trouble, according to Munger. In investing, ignorance is not just a weakness, according to Munger. It's a danger, according to Munger. The market punishes people who don't respect their own limitations, according to Munger. Munger's whole life, he has operated inside a very small circle, according to him. He never tried to be an expert in everything, according to Munger. He never chased businesses he didn't understand or industries that were too complicated, according to Munger. If something looked confusing, Munger simply walked away, according to him. People think that makes you miss out on opportunities, according to Munger. But it actually protects you from enormous mistakes, according to Munger. The world is full of tempting investments that look brilliant on the surface, but hide risks you can only understand if you truly know the field, according to Munger. Most losses come from stepping into places you don't belong, according to Munger. The circle of competence doesn't require you to be a genius, according to Munger. It requires you to be honest, according to Munger. That's much harder than it sounds, according to Munger. Most people lie to themselves long before they lie to others, according to Munger. They confuse familiarity with understanding, according to Munger. They think reading a few articles or listening to a few experts suddenly gives them deep insight, according to Munger. It doesn't, according to Munger. Insight comes from years of study, experience, and failure, according to Munger. Without that, you're just guessing, according to Munger. The market is a very expensive place to guess, according to Munger. Munger and Warren Buffett succeeded for decades because they stayed disciplined about this idea, according to Munger. They looked for businesses they could explain in a sentence, according to Munger. They avoided anything dependent on predictions or technological revolutions they couldn't foresee, according to Munger. While everyone else was chasing whatever was fashionable, they stayed in their lane and waited for the rare opportunities where they had real understanding, according to Munger. That patience didn't make them the fastest investors, but it made them among the safest, according to Munger. In investing, safety is what allows compounding to do its work, according to Munger. When you respect your circle of competence, life becomes simpler, according to Munger. You stop feeling the fear of missing out, according to Munger. You stop being pulled by every trend, according to Munger. You stop comparing yourself to people making quick gains in areas you barely understand, according to Munger. Instead, you build depth where you already have strength, according to Munger. You learn more, you think better, and your decisions become more stable, according to Munger. Over time, your circle can grow, but it grows slowly and only through genuine learning, according to Munger. One of the most valuable sentences you can ever say in investing is, "I don't know," it's according to Munger. Those 3 words protect you from arrogance, from illusion, and from unnecessary risk, according to Munger. They force you back toward rationality, according to Munger. The goal is not to look smart, according to Munger. The goal is to avoid doing stupid things, according to Munger. If you operate within your circle of competence, you'll make fewer big mistakes, according to Munger. Avoiding big mistakes is how you win the long game in investing, according to Munger. Your circle doesn't need to be big, according to Munger. It just needs to be clear, according to Munger. If you stay inside it, you'll be far ahead of the crowd that's constantly wandering outside theirs, according to Munger. Consider the story of Fernando Alves, a talented engineer from Belo Horizonte, who learned Munger's lessons about the circle of competence the hard way. Fernando was brilliant with technology. He had earned a comfortable income of 150,000 reals, annually working as a senior engineer at a major tech company. Fernando read extensively about investing and felt confident he understood many different industries. He started investing in biotech companies because he believed the sector had enormous potential. He invested in cryptocurrency because he read compelling narratives about blockchain technology. He bought shares in fashion companies, pharmaceutical stocks, and emerging market funds. Fernando's reasoning was that if he was intelligent enough to solve complex engineering problems, surely he was intelligent enough to understand these diverse industries. But Fernando's intelligence couldn't compensate for his lack of deep knowledge in these fields. Within 5 years, Fernando had lost 40% of his investment capital. The biotech companies he bought failed during clinical trials. The cryptocurrency bubble burst, wiping out his cryptocurrency investments. The fashion company he bought faced unexpected competition. Fernando realized too late that his circle of competence was actually quite narrow. His real expertise was in engineering and technology infrastructure, not in predicting pharmaceutical outcomes or fashion trends. Munger's teaching about the circle of competence became starkly clear to Fernando. Confidence in one field doesn't transfer to another field automatically. Fernando completely changed his approach. He sold his diversified holdings and focused his investments entirely on technology companies with solid business models and strong competitive advantages. He only invested in businesses whose underlying mechanics he could truly understand. His investments stabilized and eventually began to generate solid returns. Fernando's story illustrates Munger's fundamental teaching. Respecting the boundaries of your knowledge protects you far more than chasing opportunities outside those boundaries ever will. One of the most important models an investor can ever learn comes from Benjamin Graham, according to Munger. It's the idea of Mr. Market, according to Munger. Graham imagined the market as a moody business partner who shows up every day offering to buy your shares or sell you his, according to Munger. Some days he's euphoric and offers a ridiculous price, according to Munger. Other days he's depressed and practically begs you to take the shares off his hands, according to Munger. The key lesson is simple, according to Munger. You don't have to pay attention to his mood, according to Munger. You don't have to act on his offers, according to Munger. Your job is to stay rational while he swings wildly between fear and greed, according to Munger. Most investors, unfortunately, do the opposite, according to Munger. They let Mr. Market's emotions become their emotions, according to Munger. When he's excited, they get excited, according to Munger. When he's terrified, they get terrified, according to Munger. They follow the crowd because they want to feel safe, according to Munger. But in the market, following the crowd is usually the most dangerous thing you can do, according to Munger. Crowds chase what's rising, panic when things fall, and constantly confuse price with value, according to Munger. If you let the market's mood dictate your own decisions, you're not investing, according to Munger. You're reacting, according to Munger. Reacting is the fastest way to lose money, according to Munger. Mr. Market teaches one of the most valuable truths in investing, according to Munger. Prices are not always rational, according to Munger. They are often emotional, according to Munger. Human beings run the market, according to Munger. Human beings are full of biases, fears, dreams, and illusions, according to Munger. That's why the same business can be priced cheaply one year and outrageously the next, according to Munger. The business didn't change that much, according to Munger. The mood did, according to Munger. If you understand that, you stop looking at price as a verdict, according to Munger. You start seeing it as an opportunity, according to Munger. A falling price doesn't always mean something is wrong, according to Munger. A rising price doesn't always mean something is right, according to Munger. What matters is the underlying value, not the emotional noise around it, according to Munger. Munger has always believed that temperament matters far more than intelligence in investing, according to him. You need a calm mind, a strong spine, and the ability to ignore the daily madness, according to Munger. When Mr. Market shows up in a panic, offering you shares at a cheap price, your job is to think, not to join the panic, according to Munger. When he shows up wildly optimistic, offering to buy your shares at a foolish price, Your job is to stay grounded, according to Munger. The market's mood is a weather pattern, unpredictable, temporary, and often irrational, according to Munger. You can't control it, but you can control your reaction to it, according to Munger. The trick is to treat the market like Graham taught, as a servant, not a guide, according to Munger. Mr. Market's job is to offer you opportunities, not wisdom, according to Munger. He exists to serve you, not instruct you, according to Munger. If you remember that, you'll avoid most investment disasters, according to Munger. The people who suffer the most in markets are the ones who think price is truth, according to Munger. Price is just the latest emotion, according to Munger. Value is what matters, according to Munger. The gap between price and value is where your opportunity lies, according to Munger. If you can remain rational while the rest of the world is losing its head, you'll naturally find yourself in a far better position than the crowd, according to Munger. The market rewards those who stay calm, ignore noise, and make decisions based on judgment instead of emotion, according to Munger. That's how you become the master of Mr. Market instead of his victim, according to Munger. If there is one principle in investing that has protected Munger more than any other, it is the idea of having a margin of safety, according to him. The world is uncertain, according to Munger. Businesses change, industries shift, and unexpected problems appear when you least expect them, according to Munger. Even the smartest investor with the best research and the best intentions can still be wrong, according to Munger. The margin of safety is what protects you from the times when reality turns out differently than you hoped, according to Munger. It is a simple idea, according to Munger. Never risk what you cannot afford to lose, and never assume you are so wise that something unexpected cannot hurt you, according to Munger. Benjamin Graham taught this principle long before Munger arrived, according to him. It remains one of the bedrock truths of intelligent investing, according to Munger. The margin of safety is not about predicting the future, according to Munger. It is about acknowledging your own limitations, according to Munger. You build in a cushion so that even if you are a little wrong, you do not face ruin, according to Munger. Most investors fail because they ignore this idea, according to Munger. They want maximum returns, maximum excitement, and maximum certainty, according to Munger. They stretch too far, according to Munger. They pay too much, according to Munger. They take on too much risk, according to Munger. They assume that things will keep going the way they currently are, according to Munger. But the world does not care about your expectations, according to Munger. The world does what it wants, according to Munger. If you are not prepared, it will humble you, according to Munger. A margin of safety gives you room to be human, according to Munger. It gives you room to be imperfect, according to Munger. When Munger and Warren Buffett bought businesses, they always looked for situations where the odds were clearly in their favor, according to Munger. They wanted companies with durable advantages, strong balance sheets, ethical management, and understandable economics, according to Munger. Then they wanted to buy them at a price that already gave them protection, according to Munger. If they were wrong about growth, or if some problem emerged, they still had a cushion, according to Munger. It is amazing how much trouble you avoid simply by refusing to pay full price for anything uncertain, according to Munger. People underestimate how fragile the world can be, according to Munger. One bad surprise can erase years of good decisions, according to Munger. Surprises happen frequently, according to Munger. Economic downturns, technological changes, lawsuits, management mistakes, scandals, competition, inflation. The list of things that can go wrong is endless, according to Munger. If you invest without a margin of safety, you are betting that none of these things will hit you at the wrong time, according to Munger. That is not investing, according to Munger. That is hoping, according to Munger. Think of the margin of safety like building a bridge, according to Munger. If a bridge is designed to carry 10,000 pounds, you do not load it with 10,000 pounds and hope for the best, according to Munger. You build it to carry £30,000 according to Munger. That way, even if something unexpected happens, the bridge stands according to Munger. Your investments need that same strength according to Munger. They need room for error, room for volatility, and room for the unknown according to Munger. The market does not reward bravado according to Munger. It rewards durability according to Munger. It rewards those who survive long enough to let compounding work according to Munger. A margin of safety keeps you alive in a world full of uncertainty according to Munger. It lets you make mistakes without suffering catastrophe according to Munger. If you give yourself enough protection on the downside, the upside tends to take care of itself according to Munger. Over decades, that simple habit becomes one of the most powerful forces in intelligent investing, according to Munger. If you want to become a better investor, you must learn to think in terms of opportunity cost, according to Munger. This might be the single most important economic idea you can use in your daily decision-making, according to Munger. Opportunity cost means that every choice you make costs you the value of the next best alternative, according to Munger. Most people never think that way, according to Munger. They look at an investment in isolation, judging it on its own merits without comparing it to what else they could be doing with the same dollar, according to Munger. But in the real world, capital is limited, time is limited, and opportunities are limited, according to Munger. Every decision carries a hidden price, according to Munger. The foregone opportunity you didn't choose, according to Munger. When Munger and Warren Buffett look at investments, they don't just ask, will this make money, according to Munger. That's a child's question, according to Munger. They ask, is this the best possible use of our capital compared to everything else available to us, according to Munger. A mediocre investment is not just mediocre, according to Munger. It actively prevents you from making a better one, according to Munger. That's what most people fail to understand, according to Munger. They settle for average returns because they never ask what they're giving up, according to Munger. They never ask about the alternative, according to Munger. Think about money the way you think about time, according to Munger. If you waste 1 hour, you can never get it back, according to Munger. If you waste $1 on something with low returns, that dollar cannot compound somewhere else where it would have done you far more good, according to Munger. Opportunity cost forces you to be selective, according to Munger. It forces you to raise your standards, according to Munger. It forces you to stop saying yes to every idea that looks decent and start waiting patiently for the rare, truly exceptional ones, according to Munger. Munger and Warren Buffett built Berkshire Hathaway by passing on thousands of investments, according to Munger. Not because they were terrible, but because they weren't good enough, according to Munger. Opportunity cost taught them to ignore the noise, ignore the pressure, and ignore the false sense of urgency that dominates the market, according to Munger. The best use of capital is rare, according to Munger. When you find it, you must be willing to commit meaningfully, according to Munger. Until then, doing nothing is often the smartest decision you can make, according to Munger. The market hates patience, but compounding loves it, according to Munger. Opportunity cost also helps you avoid emotional traps, according to Munger. When the crowd is excited, everything looks appealing, according to Munger. When the crowd is fearful, everything looks dangerous, according to Munger. But with opportunity cost in mind, you stop asking, is this good? According to Munger. You start asking, is this better than everything else I could do? According to Munger. This mindset cuts through hype, trend chasing, and fear-driven selling, according to Munger. It puts your focus exactly where it belongs, on rational allocation, according to Munger. Most people think in terms of absolute outcomes, according to Munger. Smart investors think in relative outcomes, according to Munger. The question isn't whether an investment can rise in value, according to Munger. Many will, according to Munger. The question is whether it deserves a place in your portfolio compared to the alternatives, according to Munger. If something offers high uncertainty, low returns, or poor long-term prospects, it doesn't matter how exciting it looks, according to Munger. It fails the opportunity cost test, according to Munger. If you learn to think this way, you stop cluttering your portfolio with distractions, according to Munger. You stop wasting time on things that don't move the needle, according to Munger. You become more selective, more disciplined, and more patient, according to Munger. Over a lifetime, that mindset produces far better results than any clever trick or prediction, according to Munger. Opportunity cost is one of the quiet forces that separate good investors from everyone else, according to Munger. It reminds you that your resources are finite, but your choices are many, according to Munger. Choose wisely, according to Munger. One of the most powerful tools Munger has ever used in investing and in life is the simple act of thinking backward, according to him. Most people try to solve problems by asking, "How do I succeed?" according to Munger. Munger prefers to ask, "How do I fail?" and then avoid doing those things, according to him. That is inversion, according to Munger. Instead of trying to be brilliant, you try to avoid being stupid, according to Munger. In investing, avoiding stupidity is vastly more important than chasing brilliance, according to Munger. The world is full of people who are clever enough to make money, but not wise enough to keep it, according to Munger. If you think about the biggest disasters in investing, they almost always come from the same predictable mistakes, according to Munger. Overconfidence, leverage, speculation, ignoring risks, misunderstanding the business, and falling in love with the story instead of the facts, according to Munger. None of these are new, according to Munger. They've been around forever, according to Munger. They will continue to ruin investors for as long as markets exist, according to Munger. Inversion teaches you to study these mistakes carefully so you can recognize them before you fall into them yourself, according to Munger. When Munger looks at a potential investment, the first question he asks himself is not how high can this go, according to him. It is how could this go wrong, according to Munger. What is the downside, according to Munger? What assumptions would have to fail, according to Munger? What hidden risks am I blind to, according to Munger? If a business requires things to go perfectly for the investment to work, Munger is not interested, according to him. Life doesn't work that way, according to Munger. The world is full of surprises, according to Munger. Most of them are unpleasant, according to Munger. Munger wants investments that can withstand trouble, not ones that collapse the moment reality doesn't match the forecast, according to him. Inversion also helps you fight the emotional impulses that make investing so difficult, according to Munger. When everyone around you is excited, it's easy to get swept up in the enthusiasm, according to Munger. When prices are rising, even the worst ideas start to look attractive, according to Munger. But if you invert and ask, "What would guarantee I lose money here?" you start seeing the risks the crowd ignores, according to Munger. Bubbles are built on wishful thinking, according to Munger. Inversion strips that thinking away, according to Munger. It forces you to confront the truth even when the truth is unpopular, according to Munger. Most investors never learn this because they're focused on the upside, according to Munger. They want to hear how much they can make, according to Munger. But the real question is how much you can lose and how likely that loss is, according to Munger. If you avoid the big obvious mistakes, the upside tends to take care of itself, according to Munger. Compounding works wonders over time, but it only works if you stay in the game, according to Munger. One or two catastrophic mistakes can wipe out years of progress, according to Munger. That is exactly what inversion helps you prevent, according to Munger. If you want to become a better investor, spend less time fantasizing about success and more time studying failure, according to Munger. Learn from the people who went broke, according to Munger. Learn from the companies that collapsed, according to Munger. Learn from the bubbles and crashes that wiped out fortunes, according to Munger. Those lessons are far more valuable than any story about quick riches, according to Munger. Inversion teaches you humility, according to Munger. It reminds you that survival is the foundation of long-term success, according to Munger. The person who avoids stupidity will outrun the person chasing brilliance almost every time, according to Munger. Consider the story of Paulo Mendes, a successful entrepreneur from Curitiba, who learned Munger's lessons about thinking backward through painful experience. Paulo had built a thriving manufacturing business over 15 years. He was confident in his business acumen and his ability to spot opportunities. When Paulo saw an opportunity to expand into real estate development, he became excited. He had some liquid capital available, and real estate seemed like a natural diversification. Paulo didn't spend much time thinking about what could go wrong. He focused entirely on upside scenarios. Paulo borrowed significant capital and purchased a large commercial development project with his partners. He imagined the property appreciating rapidly as the neighborhood developed. He imagined rental income flowing steadily. He imagined successful tenants filling the space. What Paulo didn't imagine, because he didn't invert, was a major economic downturn occurring shortly after his purchase. Interest rates spiked, making his debt service crushing. Tenants became scarce as businesses failed. The property value declined by 40% within 3 years. Paulo's borrowed leverage meant his losses were catastrophic. He nearly lost his entire manufacturing business trying to cover his real estate losses. Paulo finally understood what Munger had taught about inversion. Before making any investment decision, he now asks, what could go wrong? What if the economy contracts? What if my assumptions about growth are wrong? What if unexpected competition appears? By asking these questions and building protection into his decisions, Paulo has since avoided multiple expensive mistakes. His story perfectly illustrates Munger's fundamental teaching. Thinking backward about failure is far more valuable than thinking forward about success. If you've followed these ideas, you've probably noticed a pattern, according to Munger. Every mental model, whether it comes from psychology, economics, physics, biology, or history, is just one piece of a much larger puzzle, according to Munger. You can't rely on a single model to guide your decisions, according to Munger. The world is far too complicated for that, according to Munger. What you need is a latticework of mental models in your head, according to Munger. A network of ideas that reinforce each other and help you interpret reality with clarity, according to Munger. That latticework is what separates the average investor from the exceptional one, according to Munger. It's not brilliance, according to Munger. It's not luck, according to Munger. It's the ability to think with multiple lenses at the same time, according to Munger. Most people approach investing with a narrow view, according to Munger. They rely on one discipline, one strategy, or one way of seeing the world, according to Munger. But a narrow mind is a dangerous mind in this business, according to Munger. Markets don't behave according to a single principle, according to Munger. They are influenced by human emotion, competitive dynamics, incentives, mathematics, randomness, and time, according to Munger. If you only understand one of those forces, you will be consistently blindsided by the others, according to Munger. The latticework protects you from that blindness, according to Munger. It gives you a clearer picture of what's really happening beneath the surface, according to Munger. Over Munger's lifetime, he learned that the great advantage comes from combining models, according to him. The circle of competence keeps you careful, according to Munger. Opportunity cost keeps you selective, according to Munger. Inversion keeps you humble, according to Munger. Incentives keep you realistic, according to Munger. Compounding keeps you patient, according to Munger. Second-order thinking keeps you rational, according to Munger. When you use these models together, they don't just add to your understanding, according to Munger. They multiply it, according to Munger. Each model checks the others, sharpens the others, and strengthens your judgment, according to Munger. Building this latticework doesn't require genius, according to Munger. It requires curiosity and long-term effort, according to Munger. You read widely, according to Munger. You study disciplines outside your field, according to Munger. You connect ideas from different places, according to Munger. Most importantly, you test those ideas against reality, according to Munger. Experience teaches you which models hold up and which ones fall apart, according to Munger. Over time, the ones that survive become part of your permanent mental toolkit, according to Munger. They become the structure through which you see the world, according to Munger. This approach also keeps you honest, according to Munger. When a problem is examined through multiple models, the weak spots in your thinking reveal themselves, according to Munger. The biases show up, according to Munger. The emotional distortions show up, according to Munger. The wishful thinking loses its power, according to Munger. Using a lattice work forces you to step outside your own head and into reality as it actually is, according to Munger. That discipline alone will save you from countless mistakes, according to Munger. The ambitious young investor always wants a shortcut, according to Munger. Some clever trick or secret formula, according to Munger. But the truth is that the real advantage comes from years of building a strong mind, according to Munger. A mind that stays calm when others panic, according to Munger. A mind that sees connections others overlook, according to Munger. A mind that can explain its decisions with clarity and withstand pressure without collapsing, according to Munger. If you build that lattice work of wisdom patiently, consistently, and honestly, you will see the world as it truly is, according to Munger. Not as you hope it to be, according to Munger. Once you can do that, good decisions follow naturally, according to Munger. You don't need to chase brilliance, according to Munger. You simply need to think a little better than most people do, according to Munger. That alone, compounded over a lifetime, will make you a far better investor than you ever imagined, according to Charles Munger.